everyone, happy St. Patrick's Day. My name is Mike. This is my whiteboard, and today we are going to be talking about the volatility impact of price movement and also the price movement's impact on volatility. We're going to talk about the relationship between those two, and we're going to highlight a tendency that tends to happen in normal market behaviors. So we're going to get into it, and we're going to talk about the IV's impact and what IV really is and how things are created from that volatility movement. What is that really driving, or what's driving that volatility movement? So one thing that we have to first figure out is, what is implied volatility? Well, for me, there are two big ideas when we look at implied volatility. Number one is that it's a fear indicator. It's going to give me the idea of where I can expect an underlying to go. So when we're looking at implied volatility, what it is it's displayed as a percentage on a one standard deviation basis. So if I'm looking at an underlying, let's say a stock is trading for $100 and it has an implied volatility of 20% for a given time frame. Let's say it's for 1 year in the standard implied volatility calculation. So if it's got a 20% implied volatility, that means that that underlying is expected to go within a 68% probability up $20 or down $20. Because if I've got $100 stock price and I'm looking at a 20% implied volatility, all I'm really doing is just taking 20% of that underlying, looking at the potential move to the upside, and then looking at the potential move to the downside. So as you can see from that calculation, a larger implied volatility implies a larger potential move, and a smaller implied volatility implies a smaller move. But what's really important is to realize that it is an option price indicator. So what I mean by that is we can't ever know what implied volatility is. It's not just a number that we can say, okay, this is implied volatility. With the Black-Scholes model, we actually take all of the other inputs and we attempt to solve for implied volatility. So what are some things that are taken into consideration? Well, time frame is definitely one, and another big one is the options price. So when we're looking at the option price, time goes into that. Of course, the more time we have, the more that option should be worth. And also, if options are being bought and sold, that's going to change the option price. It's very similar to buying and selling stock. If a stock is being bought consistently, that stock price will rise. And if a stock is being sold consistently, the stock price will drop. So it's very much the same. So really what we need to have in terms of a takeaway from this particular slide is that IV is a reflection of option buying and selling, not the other way around. So if we know that options are very similar to stock in the sense that if we buy them, the price increases, then we know that if options are sold, option prices will decrease as well. So it's really important to realize and understand that implied volatility is not a metric that we just know that's written on a piece of paper. It's actually something that is solved for given a number of different variables. So now we're going to talk about a relationship between implied volatility and option prices. So if I know that when options are bought, option prices increase, and when options are sold, option prices should decrease, how does that affect implied volatility? Well, if we know that the option prices are really what's driving the implied volatility factor, if I know that option prices are increasing, then I should expect to see a larger implied volatility. And on the flip side, if option prices are decreasing, I should see a smaller implied volatility. So in what situations would this tend to happen? And we're going to break that down on the next slide here. So what you'll tend to see when you look at a volatility instrument, and whatever volatility instrument that instrument is actually looking at in terms of the underlying. So in this example, I chose ES/ES, which is the S&P E-mini 500 futures contract, and the VIX. So the VIX is simply the volatility instrument of the E-mini S&P futures contract. So really what we're looking at is a situation where we have complacency and a situation where we have fear. So when we're looking at a situation when we have complacency, what you'll see is when the underlying ES goes up in price, normally what you'll see is volatility come down. It's important to know that that's not always the case. It's not a sure thing. It's not if the ES is going up, then volatility must go down. But more often than not, when we see the S&Ps increase, we normally see volatility come down. So what you'll see is when the ES price goes up, you'll see a decrease in volatility normally. And on the flip side, when we have a fear situation, and when I talk about fear, I talk about the S&P going down, and we're going to get into that a little bit on the next slide. But if we know that when ES goes up, we can expect to see volatility tend to go down, and we're in a complacency state, that means that if the opposite happens, then we should see volatility go up. So if I see the E-mini S&P future contract go down, then I would tend to expect to see the volatility going up. So that's how I want you to read this graph here. When the S&Ps go up, you'll see volatility decrease. And when the S&Ps go down, we should expect to see volatility increase. So what are some reasons for that? There's plenty of reasons for that, but there are a few that tend to stand out. So on the next slide, we're going to break those down for you. The very first one is to realize that most of the US is long. And when I say long, I mean a lot of traditional investing and a lot of retirement accounts are not allowed to be short stock or short underlying. So when we're looking at being long in the US, most of the US I would say is long. They're going to be long stock, long underlyings, and benefit from the prices increasing. So what does this mean for volatility and option prices? Well, if we know that the underlying US population is pretty much long, if the S&Ps are going up, that's why there might be complacency. Of course, no one's going to be really looking to defensively protect their positions if they're seeing profits on their positions. So when I say hedging and protecting their positions, a very popular way to do that is to buy options. So when we're looking at people being long stock, a perfect hedge would be to buy a put. It would perfectly hedge their position at a certain strike price. Of course, that's not what we do here at tastytrade, but that's what would increase the price of a put, for example. If a lot of people are buying puts to hedge a certain position, you're going to see the price of that put go up, and that's going to affect the implied volatility. So if we're looking at complacency and fear and understanding that complacency is to the upside and fear tends to be to the downside, when we're looking at hedging different positions, we should be able to make an assumption that when the stock price goes down, it makes sense that volatility would go up, because when the stock price is going down, if I make the assumption that most of the US is long, then I'm going to know that if people start to see their positions going against them, they're going to start maybe getting a little bit of panic. They might be feeling a little bit of panic and saying, what can I do to stop this? What can I do to maybe speculate on this down move? Or what can I do to hedge my positions, whatever that may be? So what we tend to see is when the stock price is going down or the underlying is going down, there's a lot of hedging taking place, which can consist of buying puts in a traditional sense. And when options are bought, as we know, when options are bought, it's going to increase the price of the options. And if we know that the option prices are what drive implied volatility, that's where you tend to see that relationship where when prices are going down because of the fact that people are panicking and looking for hedges, looking for ways to mitigate that loss, a lot of times that's going to inflate the option prices because of that activity in the market. Another thing to consider is that velocity is to the downside. So when we look at different moves and different large moves over time, what you'll find is that the sharpest moves come from major sell-offs. There are certain situations, I remember last year right around Christmas, we had 2 days in a row where we were up 50 points in the S&Ps and then up another 50 points. I think we covered 100 points in 2 days, which is pretty rare, and that was the first time and pretty much only time I had ever seen such a big move to the upside in consecutive days. But when you look at previous crashes, you can see massive sell-offs in a very short period of time. So if we can agree that velocity is to the downside, and we know that fear can then be associated with downside moves, that's where we can kind of tie in the relationship between volatility increasing when prices go down and vice versa, volatility decreasing when prices are going up. So I made this last sentence here. If we assume most of the US is long, it makes sense that hedges and speculation come into play when there are down moves in the market. So tying all of this together, knowing that most of the US is long based on the fact that we have retirement accounts and we had traditional investing where a lot of people are using buy and hold strategies as opposed to selling high probability trades around premium and implied volatility overstatement like we do here. And we tie that in together with velocity being to the downside. It totally makes sense when we think about why volatility increases when the underlying price goes down. So let's wrap all this together with some takeaways for you. The very first takeaway is that IV tends to increase when the markets drop. I say it tends to increase because there are situations where you might look at your portfolio or you might look at your watch list if you've got, let's say, ES and the VIX or any other underlying and its volatility instrument. There are situations where you'll see the S&Ps go up and volatility will also be going up. So that's a pretty rare situation, but it does happen from time to time. So it's really important to realize that while these relationships do exist, and there is a pretty strong negative correlation between the S&Ps and volatility, it's not always the case. And that's why it's really important to weigh correlation and take it with a grain of salt, because even though we can have such a strong correlation when we're talking about like the S&Ps and the VIX, it's not always going to be moving against each other. There are situations where you might see the S&Ps go down and volatility go down, or the S&Ps go up and the VIX go up as well. Secondly, IV is a reflection of option activity, not the other way around. So when I first started trading and I learned about implied volatility, I actually thought that implied volatility was what was driving those option prices. But now that I know that it's the opposite, it does make a lot more sense. When we look at the Black-Scholes model and understanding the inputs and how implied volatility is solved for, not an input into that Black-Scholes model, it does make a lot more sense, and it does give us that understanding of these relationships. And lastly, speaking of that relationship, understanding how this works gives us a better understanding of the markets in general. If we can take away from this that there does tend to be a relationship between volatility and its counterpart, while that is true for most of the time, it doesn't always have to be. So there might be situations where we see volatility go up and the S&Ps go up and vice versa. But because of the fact that we know that option prices are what is driving implied volatility, and we can usually make a relationship between complacency and fear, where fear is to the downside, complacency is to the upside, because of the fact that most of the US tends to be long, it gives us a clear relationship and why this relationship exists today. So thanks for tuning in. Hopefully you enjoyed it. If you've got any questions or feedback, shoot me an email at one of these emails here, or you can follow me at DoTraderMike. Stay tuned though, we've got Jim Schultz coming up with From Theory to Practice. We'll see you next time.